Hey folks, welcome to yet another conversation on Business Redefined, your weekly most comprehensive look at the world of business, finance, and economics. We are still on the banking earnings cycle. I&M put out stellar set of earnings, everything up in the double digits, including the net earnings. And we are privileged to have the regional CE, that is Mr. Kihara Maina. Karibu sana.
Asante sana.
And welcome to Business Redefined.
Thank you. Good to be
How
here.
is this the first time we're sitting here?
I'm wondering, is it only when we have a good story to tell we get invited? We'll do more
Karibu
of
sana,
this.
man. You have a very strong story on your P&L. We can discuss the balance sheet a little later, but let's start here. Your two engines, funded income, non-funded income, are both firing in double digits.
Yes.
If you look at this season, majority of banks took quite a hit on the funded side because of the repricing we saw from the central bank. How did you navigate that?
So thanks, Julian. So yes, indeed, double-digit growth in both those drivers. And on the balance sheet side, you start with, yes, there was asset growth, 7%, and we ended up at about 307 billion shillings in terms of the loan book. But you also had very strong growth on the deposit side, right? Yeah. And when we look at that 3% growth in the deposit book, and this is across the group, that is going to drive a lot of surplus liquidity that you then are having to deploy. Yeah. That went into our government securities. Now, if you look at where that growth in our deposits was coming from, significantly from CASA balances, which means that you're also bringing...
Cost of funds. Yes, exactly.
So that has helped us to preserve NIMs. And that has meant that the double digits story that you're seeing on net interest income has come from that, right?
Okay.
Yeah.
And even as you talk about ramping up on your deposits and, of course, the opportunity you saw then in government paper, Kihara, your loan to deposit in the low 60s from my math, and I'm looking at it at group level, you surely have some headroom there, man.
Yes, indeed, actually. So we are the exact number, I think, is 63%.
There you are, yes.
Right. I know you did the quick math yourself, but 63%, and that's come down from about, I think it was about 72 or 73%.
Yeah.
Now, that does tell us that we want to, or we have an opportunity to do more in terms of growing in the real sector, if you like. But the reality is that we have actually had a very strong story on the deposit side, right? Far outpacing the growth in terms of the credit side. Now, we know the global numbers, at least for Kenya, where we are talking about just about 6%, I think is the last reported number coming into 2026 in terms of credit private sector. What that means is that the ability to really deploy this in lending has been somewhat limited. Now, it's not all doom and gloom in that regard, right? Because we have been supporting a lot of lending in the MSME space and in the retail space, which has been a big focus area for us. And particularly doing high velocity sort of loans, short-term cycle loans. So like our 30-day loan product, we have disbursed just this year around about 5.5 billion shillings. This is the past year, just simply from the repeated use of that line, right?
Yes, yes.
So yes, we have been deploying credit, but it has been changing in the places that it goes. If you look at our ecosystem play in Tanzania, where we have a partnership with Airtel, again, also a very strong story. There's a product we call Kamilisha there. It's a fulfillment product for lending. And again, a very strong story there. We are supporting over 4 million customers in almost, you could call it day-to-day borrowing. Yes. So that kind of reshaping in terms of where the credit is going in the retail space, that has certainly also contributed to the net interest income story.
One area where, again, you're an outlier in the industry, a lot of banks have taken a lot of hemorrhage on the FX trading income line. Yours seems to have been playing in a different market. How did this happen, Kihara?
So a mixed story there. We have, let me say, not suffered as much as the rest of the market.
True.
So we've somewhat contained that hemorrhage that you described. Part of the reason is because we had two key interventions last year. One was a big push into partnerships with remittance companies, right? And that has led to us being positioned really as the leader in terms of that last mile conversion for remittances. We are now actually doing around about 25% of remittances into the country coming through us in terms of those partnerships. But the second one is also how we have now started engaging with customers on our platforms in terms of foreign exchange trading. So we introduced FX Direct last year, which is a platform that allows us to sign up customers and they then trade on that platform. We have also put in FX conversions on our OTG channel, right? So as customers are looking to make payments to their kids abroad or even to do their corporate payments, they can also do it on the OTG app. And that has helped shore up the FX side. It's still not where we'd like it to be, but at least it stemmed the bleeding in that regard.
So to close that conversation then, how do you feel about the mix between your funded and non-funded income as a proportion of your total income?
So non-funded income is something that we have talked about for a long time, about keeping on driving it up, right? A recent analysis we did showed that if we really want to impact, I think, the perception of value by shareholders, we have to get even stronger on the non-funded income side. It needs to be in the region of the 30 to 40% space for it to be seen as a solid pass-through into value, right?
Yes.
So that's something that we are actively working on, and we're looking at different levers to drive that. A key one is advisory income that you will have seen was a good play for us in the wealth management space last year. Our wealth management business drove the assets under management up to 99 billion shillings, right? That's a threefold increase in just 1 year. And that was also just seizing the opportunity to really provide alternatives to customers who are looking for returns, right? We are very rate sensitive or yield sensitive market. So it was timely. This is just a 4-year-old business and we're already producing 500 million shillings in terms of earnings. That's fantastic.
Kihara, as we venture into 2026 and Q1 is already behind us, the indication we have, at least from the market regulator, is that the unrelenting and unwinding of the benchmark rate we saw last year is not yet complete. Mm-hmm. Effectively, NIMs will continue to come under pressure. Mm-hmm. What's your game plan for this year?
So I think the push that has been underway for quite a long time is really focused on how you can drive transmission of monetary policy into the economy, right? And the risk-based pricing was something that we had actually developed models on and were looking at how that actually fixes to an individual client driven by factors like your sector drivers, right, of risk. What we have now settled on as an industry is linking either to the Kesonia construct or to the CBR, which means that you now have a direct link in floating rate, Kenya shilling floating rates loans to what the policy rate is. So you, however, do need to make sure that that transmission mechanism is solid, right? Because it shouldn't only affect just lending rates. Yeah. It should also affect deposit rates, right? And now you have a disconnect because the previous construct considered your cost of funding directly. Yeah. Now it's coming essentially into your K, right?
The premium.
Yes, into the premium, right? And I always have to remember to stop using acronyms, right? But yes, this is becoming the language that we will all get familiar with. Yes. What we have been alive to is that a lot of our pricing on the deposit side comes from other benchmarks, like your treasury bill rates. Yes. I mentioned earlier that people are very sensitive to yields in this market, so that tends to drive deposit pricing. And if that continues, then you may end up having a disconnect. You could have fiscal policy
overbearing.
Exactly.
Yes.
And that can be very, very challenging because then you're just going to see contraction because of different agendas that are at play. So our focus then should be to say, how do we actually get the Kesonia construct or the CBR driving deposit rates as well? What I'd like to see is Kesonia term rates, right? So you get, yes, your overnight, but then you get a 1 term, a 1 month term, a 3 month term, and so on, which is then reflective of a yield curve that we can actually price off of. And once that happens, then you remove basis risk, right? And you're able to then say, okay, fine, I can manage the spreads because I'm actually pricing off similar benchmarks.
Yes,
so
yes.
this is something that the Kenya Bankers Association is looking at. So what do we do then in the intervening period?
Yes.
It's strengthen our asset and liability management, make sure that we are understanding all of these different moves, because unfortunately we've also seen some challenges around how that rate is going to move, right? The CBA, the lending rates.
Yes.
Because we know how it moves when it goes down. We don't know how quickly it can revise if you go up.
Especially considering the risks we are now seeing.
Exactly.
Yeah.
So we want to be able to have that flexibility, because even just simply from a policy perspective, you want that mechanism to be able to transmit both directions. If you introduce some friction because you have to go and talk to a cabinet secretary to get your rates up, then you're not going to actually achieve your monetary policy effectively. You want to do this right.
And in case you're lost, she's mentioning Section 44 of the Banking Act, which has been a matter of contention between the regulator, CBK, and the banking sector, and we're still debating it to see the way forward. As you speak about prudent management of assets and liabilities, Kihara, one of the things which stood out to me, you appear to have a very firm hand on your asset quality, but your cost of risk didn't seem to adjust concurrently with what you're seeing there. Yeah. Why is that? You could have unleashed more in the P&L, I think.
Well, so you have to really go with what your policies actually allow you to do, right? And in our case, we actually did see provisions go up, right? So they went up by about 11% actually to just about 8.7 or so billion shillings. Now, what that means is that if you look at the relatively lower growth in terms of your net loans and advances,
yeah,
then your cost of risk is going to tick up.
Correct.
Right?
Correct.
That does look like it's counter to then the NPL ratio coming down. Now, NPL book came down 36 billion to 31 billion shillings, but then again, juxtapose that against the total book that we are looking at, and you will see that you then get your NPL ratio down, right?
Yes.
So that's good. However, it does reflect a lot of work that has happened, and I must commend our credit and recoveries teams across the group. They've done commendable work to just make sure that they're diligent in following up with clients on how to really reduce this burden that we've had on non-performing loans. So very strong recoveries across the group. And it is work that we intend to continue.
Yeah.
We are also, of course, being a lot more proactive in spotting when this trouble is coming so that you
Yes.
don't actually get to that stage.
Your early warning.
Yes, exactly.
Tell me, a number of banks are indicating to me that ever since FY23, this is the first time where we have a macro environment which appears facilitative of recoveries. Mm-hmm. Are you experiencing the same, or it's more internal administration?
So I think it's a combination of both. You do have a cycle with these things, right? So initially it can be very tough. You therefore have to pick up a lot of the provisions to just reflect the decline in quality, right? Then now you start working on the recoveries, right? You are going to have restructures that if you now start seeing, for example, better performance in the economy, we have seen credit to private sector growing. That suggests the demand, of course, is rising, and whatever it is that was challenging our clients, you see some opportunity for them to recover. So supporting them with restructures then helps you with curing, right? And that then drives the recovery process a lot better. And we have seen that in our different markets, right? So you negotiate with somebody, give a bit better runway for them to come back into performance, and eventually you're actually putting them into the normal portfolio, which is always a great story. We want to work with our clients to make sure that they can actually survive. I know there's a lot of reluctance typically to really just calling it as it is, and that's where the court system then comes in, and you find that you're taking too long to actually resolve issues. And that's painful. I'm sure if you look at the level of cases or the amount that's been locked up in court battles.
It's quite tidy.
Yes, it's very tough, and we need to get better at this.
Is it fair then to infer from what you've said that your headache, if I could call it, from an NPL perspective right now, is more of the stage 1 to stage 2 flow as opposed to stage 2 to stage 3?
Yeah, these are flow rates that we look at closely, right? So stage 1, stage 2, that movement maybe not as challenging,
Yeah.
right? Actually, I'd say both of them are well contained. They're within appetite in our regard, right? And hence you've seen that we've kind of gone counter to the industry.
Yeah.
But remember that the books that we run are also somewhat different, right, in the industry, especially in the retail space. Because if we start getting into short cycle loans, you're working with ecosystem plays, right? You're doing unsecured lending.
Yes.
You will see initially as you're earning your school fees, you will see a tick up in that. But we are getting better at it. And we have found that if we look at the unsecured side, that's now starting to move into what we call our scheme lending. So we are working with our clients and lending to their staff rather than directly going and lending to the public in that way. And there you have tended to see bigger ticket loans, right? People are looking to buy cars, they're looking to buy plots, they're looking to do home improvement, pay school fees. These are big tickets. Whereas if you look at your short cycle loans, your digital loans for 30 days, those are small tickets,
Yeah.
but revolving frequently.
The channel.
And then you've got the corporate and institutional banking aside. There again, you're now you have the opportunity to be a lot more selective, right? Because you're going to be really critical about what the drivers of credit in that market are. You'll be able to see how the rest of the industry for that client is actually doing. So you can actually make a very informed decision about that, and you can keep the credit downturns to actually perhaps macro issues that are affecting the industry. So that's the direction we see it playing out, and we are actually happy with the level of NPAs that we are now seeing, and they are continuing to improve.
Kihara, it looks like even as you look to deepen your penetration in the retail space, you are still niche playing in that category as opposed to going for scale.
Not quite so, actually. So what we have done in the lending space, we have become a lot more particular about how we are doing that retail lending, right? We're continuing to innovate in that space. So we've done the 30-day loan that I talked about, the digital loan, very successful. We've said, what are our customers then telling us about how they would like to see this changing? So should we go a bit further out? What does it tell us about credit quality? If we're doing, say, a 90-day loan, right? Or an overdraft. We're looking at some of the ecosystem plays that we have with our telco partners. And we're looking at what more beyond a fulfillment product, right? You're buying airtime, you don't have enough money, you borrowed to fulfill that, and then you recover the money shortly thereafter when you top up. What more beyond that can we do overdraft type products and so on? So there's a lot of innovation happening in that space, right? The ecosystem plays allow us to reach a lot more customers, right? If we look at our Tanzania partnership with Airtel, that's giving us access to 4 million customers, right? People wouldn't have acquired. If we actually look at the number of customers we have in Tanzania, they are just under 40,000. But if you then add on to the ecosystem plays, you're now talking 4 million customers, and these are people who are actually driving your loan book growth. So I think we're being innovative in the retail space. If you look at our expanded reach, right, we are now in 28 counties, right? Previously, we were just in under 20. And this is continuing. We're planning to open a few more branches this year. We're looking at other propositions that we can offer to clients. Non-interest finance as well is something that we're looking at in Islamic banking. That's something to follow, for example. So it is an expanded play, and we are investing heavily in the brand building that must happen for people to actually consider what you'd be describing as a niche kind of brand before. It needs to be more widely known, and that is happening.
Kihara, for all the green shoots you have in your numbers. Question to you. When do we play within the 20s in the ROE space?
We're just knocking on that door. Last year, we've just reported it was 18%,
Yeah.
right? Our ambition is to be in the 20s. We've always said it. It's been moving. 24, it is 17%.
I thought Imara 3.0 should be there.
That is the ambition, actually, to be in the 20%. And that's where we're targeting for 2026 as well. In a couple of our businesses, we're already there, right? But when you look at it in the group, at the aggregate, that's where it is at 18%. In Rwanda, for example, that's already past the 20% mark. And it's one of our mature businesses doing really well and expanding into even higher yielding segments like the retail space where we haven't played before. And we expect that all of these different initiatives coupled with capital management will drive that kind of outcome. But we are very happy about actually what it really means to our shareholders as well, right? Because it's your net earnings that you're ultimately distributing. And if we're talking about a 25% increase in our dividend, that is a really good story for them, while you're actually conserving capital to be able to grow.
Yes. You are basically wrapping up a strategic horizon, Imara 3.0. Give us a reflection and what will inform the tail end and what the pathway ahead looks like.
So I think we've done very well in this cycle. We've had 2 very strong years of Imara 3.0. We've seen actually growth, compounded annual growth rate in the high teens or even in the 20s like in last year. And this has been driven actually by the strategic focus that we had set out on, right? So to just recap, our first pillar in Imara 3.0 was how do we actually entrench ourselves in the corporate and institutional banking space. We have always been well entrenched in the manufacturing space, but we wanted to expand in broader manufacturing in other segments that we perhaps were not just as strong at. Over the last couple of years, we have strengthened our presence in the steel space, and that's across the region. But we've also looked at new sectors. We've looked at oil and gas. We are now the second largest player in oil and gas, actually, when it comes to the G2G side. We are looking at the entire value chain and seeing how we can support that as well. And even in the associated industries with oil and gas, like your transport for oil in the new pipelines that are coming in, we have also been expanding our appetite into that space. So the contribution from these new areas, and we have that also includes supporting agribusiness and supporting leasing as well. That has continued to really drive the revenue from new business, and that's at about 24% contribution to the 17 odd billion shillings that the CIB space has made. So that was the first one, and we continue to really strengthen our efforts in that space, particularly driving automation and further capital committed towards those segments. The second pillar was where really growth opportunity in our markets comes from, right? You have a young demographic, very innovative in all of our different markets. We have a clear understanding that if we want to be relevant in these spaces, we have to be supporting the type of business that they do, right? 99% of businesses are SMEs, right? We want to be able to say, actually, we can help you with your working capital needs, right? They're unique. They are maybe very short cycle, right? They are always linked to the individual. We want to couple that with mitigations when it comes to offering credit in that space to try and protect. We know about the high failure rates in the SME space. Yeah. A lot of it will come from just making sure people understand what they're doing in terms of running their businesses for bankability, right? So how do you make sure that the story you're telling as a business can be understood by a banker? Because what are they looking for? Yeah. They want you to say you understand their cash flows. What kind of pattern do they have? And therefore, when you're looking to bridge for them their working capital needs, what kind of solutions do you offer? If you offer stock products that are not really speaking to their needs, you're not helping them. Their cash cycle isn't really helping them to actually meet that kind of standard product. So how do you create solutions that can actually work to that? But even broader than that then is to say, we know these segments have linkages into the corporate space. They are supplying somebody, right? They are buying from somebody. How do we support them in that value chain space, right? So here we have set up new products like our supply finance products. We do work with the corporate anchor clients and then work with their value chains. So then also understanding where they are to be found. You know, one of the focus areas for banks in the last few years has been the role that digitization is going to play in accessing your clients. And you have seen even attempts to get a fully digital kind of model to acquire clients and service clients. Our experience has been different, right? And you've seen the reference to phygital presence. That has been our experience. So yes, you're going to increase your ability to acquire customers. They onboard digitally and so on, and we have been really successful at that. Of the 224,000 odd customers that we put on last year, 60% actually came on our digital channels. But people still want to see your brand out there. So you have to be able to, exactly. So open your branches. That's why we have opened roughly about 32 branches now in just the last 3 years or so. And I talked about the geographic distribution in the counties. It's very important. And then you really truly have a chance to be relevant in those communities, because then now you can participate in the things that are important to them, right? You can look at that county and the kind of challenges that they have, that they're dealing with, and how you can really curate solutions for them. So that was our second pillar, and it is growing very well. And then the third one was the ecosystem play, which is to say we appreciate we can tap into the clients of other partners and co-create solutions for them that actually drive value, not just for our ecosystem partners, but for the clients that they actually have. And that has worked well. We've seen it very well, in particular in the telco space, where we've had partnerships, successful partnerships in Tanzania, in Kenya, in Rwanda, and now working also on Uganda. But other ecosystems that really tap on our corporate client base that we know so well, and understanding the kind of solutions that they say would help them really drive value down their value chains, then that is something that has also grown pretty well. It has contributed 8% of our PBT in just the last year. So very well done, I think, in the story so far for the Imara 3 cycle.
Yeah.
So looking forward, then we are saying, okay, we know there's still going to be some hangover, let me say. And we have seen this in the 3 cycles that we've had. Things that we have built in the first cycle need to be nurtured to maturity in the second cycle. So we will continue on the digital play. And here we have seen evolving stories, right? So AI is your new buzzword, and everybody can get excited about it. Where we focus is how do we actually use it within our business to drive value for customers, right? So we're looking at use cases that make sense to us, right? What kind of insights can we get about a customer's business with us that is then going to allow us to design a new product that is going to support them? What is it that we can actually drive for our customers in thinking about their own strategy from the data that we see about how they conduct their accounts? So we're still thinking through all of those areas. We're going to look at what the landscape tells us about focus, but it's an interesting story. We're getting better at this. So I'm sure designing this new strategic journey for Imara 4.0, if that's what we will call it, will be something that will be exciting all around the group.
I can't believe our time is out, Kihara. So let's wrap up this conversation. 1, I&M Kenya, MD recruitment. Are you closing in? How far are you?
So that's a process. That obviously started immediately the past CEO left. And the board is obviously very, very focused on it, and is working with the right kind of recruitment partners to get us to where we want to be. So that's just the process. We know it's going to get its finishing point.
Which you don't have a target on.
Yeah, we want the sooner the better, because obviously we want to make sure that we have all the right leadership in place across our business. We worry about vacancies at senior level because it can lead to challenges. In the meantime, we have a wonderful senior leadership team in Kenya, and they're doing a great job of holding the fort. So we just want to complete the picture.
Would a retail skewed pick be your sweet spot?
So I think that what skill sets the new CEO brings in is going to be important in adding to what the team already has. But you're looking for leadership, you're looking for experience. That those experiences may be different, but they have to be complementary to what we already have. So those are some of the considerations that they have. Now, of course, we're still doing a retail build-up, but we have very strong retail people, right? And we are also doing a digital play. We have very strong digital people, right? So all we're really looking at is, can we get great leaders?
Final question, Kihara. This market is undergoing recapitalization. Mm-hmm. And I have heard an intimation that I&M is looking to grow inorganically as well. Mm-hmm. I've also had intimation that I&M is a prime target for an acquisition. Any thoughts around those?
So it's good to hear that we're always considered attractive as a bridesmaid, as a bride, right? But I think that's just validation for what our strategy has been doing. It tells us that we are creating great value, and people would like to see that as part of their story, right? But we are comfortable where we are. Right, we already are very clear about what our strategic direction is. We want to scale, and we would look at any discussions along that direction and see what merit there is in it. But we're very confident about the current capability that we have. We're very confident that our shareholders have the support or can provide the support that they need for our strategic direction. So it's not something that we worry ourselves about, right? In terms of the acquisition opportunities, so the inorganic play that I think everybody is looking at from the capitalization side, I think that we have always been clear that inorganic is something that we would like to do as well to be able to achieve our growth ambitions. But what we choose to do has to make sense to us, right? We don't want to expend a lot of effort on a small acquisition. Doesn't make a lot of sense, right? We can probably grow that much in 1 year, right? So
organically.
Organically. So what is clear is that it has to make sense for us from that perspective, so sizable enough, or perhaps better for us would be to really look at complementary plays, right? Giving us capability that we don't already have, right? That can help us, that we can actually scale quickly, right? So it doesn't have to be a bank. We can look at other types of
Fintech
entities and so on. So we keep our ears open. We always listen to whoever comes along. And if the right partnership comes along, we will certainly take it very seriously and move it to fruition.
But you still preserve quite a bit of capital despite your dividend bump up. I began making inferences from there.
No, I don't think you should read the tea leaves there. All right. We also have headwinds that are facing the region, right? And we have to say, how do you actually, because capital is there to absorb shocks as well, right? Yeah. So how do we make sure that we protect ourselves if there are any downturns that are unexpected? So we are also supporting growing businesses in our different markets outside Kenya. There's a lot of growth opportunity. Some of it might need capital. So we're always keeping our powder dry.
Mr. Kihara Maina from I&M, always a smooth operator on these questions, whichever way you bring them. Thank you so much for your time, sir.
Thanks, Julian.
We've been ripping through the FY25 earnings for I&M, a bank with quite an ambition, especially as they wrap up Imara 3.0 and look into the next strategic phase, which of course we shall keep an eye on and bring you the latest as and when it unfolds. Keep it Business Redefined.